Hi everybody, welcome back to my YouTube channel. Today's video is going to focus on investment tips for February 2020. You can use this information for all asset classes and you can use this information all year long. The reason why I specifically mentioned this particular month is because there's certain headlines which I'm going to bring to your attention which I think you should be aware of if you are already investing or if you're about to start on your investing journey. It's just a good idea to know what's going on in the world in general in finance, to get an idea of my views in terms of how I think the market should react in the month of February. So let's get started. The first and most important piece of advice that I could give an investor is that you've got to make sure that you know what you're investing in. I think investing is a very personal journey, and I know that there's some websites and individuals who tell you specific names to buy or specific companies to buy, and that individuals may go out and buy these, but you've got to make sure that you do your own research. That doesn't mean to say you have to be a complete expert, you need to burn the candle at both ends going into all the detail, but you've got to have an idea of what you're going into in the first place. A good place to start would just be to look at how this particular asset or company has behaved over the last 5 to 10 years. Give yourself an idea of the historical returns so that you can actually start to gauge what you can expect for the future. Because things like equities, stocks and shares, housing, bonds, currency, they all behave in slightly different ways. Even certain companies are more volatile than others. So by looking at the historical returns, this can give you an idea of what you may expect in the future. If you're using a broker or you're going through a third party to do your investments, you've got to know what fees you're paying. This is absolutely critical. So the key point here to make is that before you make any investment, you've got to know what you're investing in. Taking advice from individuals without doing your own research or buying things because other people are buying or because you've heard they're doing very well is not a good idea. So tip number one is always make sure you do a little bit of your own research just to get comfortable with what has happened in the past, to give yourself an idea of what may happen in the future. The second tip is just to make sure that you understand what your risk profile is and what your time horizon is. So your risk profile is really how much volatility you can withstand. And if you've done your research, at least to see what's happened in the past with whatever you're investing in, it should give you a good idea as to whether you can withstand the volatility. One example could be Bitcoin. This is a very hot topic at the moment, but the price volatility in this particular asset class is significant. So if you, for example, look at what's happened in the past and determine that actually your risk profile doesn't quite fit in with how Bitcoin has behaved, then obviously you can stay away from it. And then your time horizon, which is simply how long before you'll need to access the money. Generally speaking, the longer your time horizon, the better, because it means that you can withstand any sort of really sharp swings in the price and you give the asset enough time to recover. But if you've got a shorter time frame like myself, I've got two portfolios. The first portfolio, the time frame is relatively short, so I use that to generate an income on a month by month basis. So my risk profile in this particular portfolio, I would say, is certainly less than, for example, my pension, which is my second portfolio, and that I don't need to access for another 20 odd years, so I'm able to take on a lot more risk in my pension portfolio. So tip number two would be to make sure, in conjunction with tip number one, where you've done your research, that you have a very good understanding of what your risk profile is and what your time horizon is, and that what you're investing in, your expectations of how that asset is going to behave, is in line with the research or what you have found out or what you have determined about your own risk profile and your own time horizon. The third tip is really just to say, don't try to time the market. And what I mean by that is that, generally speaking, in investments, the idea is to buy low and sell high. And that sounds like common sense, but it's quite hard to do perfectly all the time. So the best thing to do is to do your research, get comfortable with the particular asset that you're buying, and then just get started once you've done your research and made sure you're comfortable, and then extend your time horizon so that you can give yourself a bit of time to see how your asset class or how your investment goes. And so what I want to say, one thing I want to make very clear in this video is that investing is not magic, it's actually a lot of work. And so in this video, the idea behind some of these tips or this advice is to give you the confidence as an investor to be more qualified in your decision making process. And what I mean by that is, rather than giving you specific companies to go out and buy, I'm a firm believer that actually, if my advice can help you define a very clear process that you can follow and have confidence following that, then that makes you a much better investor. So tip number 3 is, don't try and time the market. Don't try and just say, well, actually everyone is doing this, so I'm going to go and buy, or the price is falling, so I'm going to pile in and buy loads. No, do your research, make sure you're comfortable, because what is actually going to make you money is actually doing proper due diligence in the companies or whatever asset you're buying, and actually having a fairly long time horizon. My 4th piece of advice is just to have a clear understanding that there's nothing that is risk-free. So that simply means you've got to factor in risk in your investments. There is nothing out there that is guaranteed, and you need to align your expectations with the investments that you're making. So that goes back to my very first tip. You've got to make sure you do your research, and also whilst you're doing your research, make sure that you factor in what you're seeing that has happened in the past in terms of aligning your expectations for the future. Markets can be irrational. They can actually go down significantly or go up significantly. So once you get a clear understanding of this, it can really help you get more comfortable in terms of your investments. The 5th piece of advice that I would have for any investor out there is just to remove emotion from all your investment making decisions. Make sure that you only invest the amount of money that you know can allow you to have a good night's sleep. You don't want to be up at night worrying about your investments, because there will be periods where it does well and there'll be periods when it doesn't do so well. So what you put aside in terms of your investments is almost as if you have to be able to forget about that money, but you're still doing your research, you're still doing your due diligence, you still got an interest in what's happening in your portfolio, but you're not so emotional about it, because it can get very hairy. It can move in a way that can be quite difficult sometimes to explain, and this is by people who participate in the markets all the time. So you as an investor have got to make sure that emotion is removed from your investment making decisions. I've got 2 portfolios, and there's one portfolio that does phenomenally well at times and not so well at times. This is the portfolio that I use to generate an income, and I have to always make sure that I remove emotion from my investment making decisions. But there are days when things swing about quite a lot, and it is very, very difficult. But that would be my advice to you, because depending on your risk profile and your time horizon, you're probably going to be investing for longer periods than I am in my first portfolio. So I would just say remove emotion from all your investment making decisions. Consistency is very important in investing. It's a bit like anything that you do in life. You know, if you just do a little bit here, a little bit there, it's quite hard to see results. So I would say another piece of advice is just to make sure that you consistently put money away to make your investments. It could be on a monthly basis, and this will help to build up your portfolio. Not only should your portfolio go up in value through wise investment decisions, but also just making sure that each month consistently you put some money away. And then my last tip is really just to say that you've got to have a natural interest in investments. You have got to put in a bit of work. You've got to learn a bit about what's going on in the world, how this has an impact on your portfolio. And you can do that quite simply by looking at some of the videos on my channel. You can look through Google, you can watch the news. I watch CNBC, get a good understanding of what's going on in financial markets. And if you watch it between 8 p.m. and 9 p.m. GMT, this generally has a summary of what's gone on during the day. You can also pick up good newspapers that have a good financial section. And this is very important in terms of monitoring what's going on in the world, and this could give you an idea of how it could affect your investments in February. Most people start off by buying stocks and shares of particular companies. Now, as time goes by, I'm going to be sharing with you what I do in my portfolio, but this is just to give a taster or to give you a bit of information about what I do. Because I'm interested in what goes on in the world on a very high level, I don't buy individual names. I actually buy indices, which then I can use to determine what I think the overall direction of the market would be. So for example, an index would be the FTSE 100 if you're in the UK, or the S&P 500 in the US, or the DAX in Germany, and then I decide whether I think the market is generally going higher or lower, and then I invest in these particular indices to be able to capture that. And the reason I like doing that is because it allows me to take a very high level view of what's going on in the world. So generally speaking, if the headlines are positive, or I think, there's positive news to come out in the next few months, for example, then I would generally buy those indices, and that should be able to give me the exposure to capture that. Finally, I just want to touch on some headlines that I think you should be aware of in the month of February. So there are three key points that I want to highlight here. The first being the US presidential impeachment trial. The market fully expects Donald Trump to be acquitted. So generally speaking, the US president is perceived as being a positive for the US economy. And so therefore, if he's acquitted, the market will react in a positive way to this. So I'll be watching that trial very closely. I'll also be watching how the discussions between the UK Prime Minister Boris Johnson and the EU are going on Brexit, because if that goes well, or the noises coming out of those meetings are positive, then the market will react well to that. If they're negative and both parties are digging their heels in, then this could lead to some volatility in equity markets. And then finally, the coronavirus, and I'll be watching closely to see what the World Health Organization says about the virus being contained, because again, if there's any uncertainty there, or this looks like a pandemic, the market will be a bit worried about how this is going to affect demand globally, because China is a big consumer of what the rest of the world produces. So these are the three key headlines that I will be watching to see how they pan out in February. And so that brings me to the conclusion of my video. I hope you've enjoyed it and you've taken some inspiration from those tips, and I wish you all the best in your investing, and until the next time, goodbye.